So who am I? So I am Risha Reed. I work at Georgia Tech and I work specifically in the area of student innovation and undergraduate research. We're so excited today that we get to see Joelle Fox. So Joel is a seasoned finance executive with over 20 years of experience leading accounting, acquisitions, and integration. Operational finance as well as along with startup operations in both the corporate and startup environments. Joel is the CFO and operating partner at Tech Square Ventures and Engage, and in this capacity, she manages fund administration and accounting. She supports the investment process and also assists portfolio companies with finance and operating strategies. We're so excited that Joel is here today to provide us with key insights that every startup and entrepreneur should know to be successful in their finances. I'm going to stop sharing right now and I ask Joel to do the same. Thank you so much, Joel.
Hi, everyone, and I'm so excited to be here today. I can't see the chat. I can't see who's in, so welcome to everyone. And when Risha asked me to share knowledge about basic financial forecasting for startups, she told me that many of you have an idea, but you don't know where to start on building a model. And some of you may have been taught in finance how to value Fortune 500 companies, but you don't know where to start on valuation of a pre-revenue or early stage startup. So my goal today is really just to help you get started on building your model and to gain confidence about the elements of what is in a basic financial model. So about me. My career started out in with one of the big four accounting firms,
Joelle,
PricewaterhouseCoopers.
can you hear me?
Sorry.
I don't think you've started screen share yet. Nami here, if
Hmm.
you want to do
Um,
that first.
yep, yep. Thank you, Nami. Thank you. Nami is here as now. Okay. So a little bit about me. I started out in Big Four accounting. So I started with Price Waterhouse, going deep in financial statements. I had a really fun career at Price Waterhouse. It was 8 years, and it kind of sounds a little geeky to say you had fun at a Big Four accounting firm, but some of the fun projects that I worked on were the Atlanta Olympics, and our goal when working on the Atlanta Olympics was to make sure that we didn't that costs didn't outstrip the revenue. So we had to look at the forecast to make sure that it would be a break even for Atlanta. So I got to learn a lot about marketing and the Olympics. Another fun project at Price Waterhouse was we audited Ted Turner's film libraries. So I spent summers in LA at MGM, and we had a lot of fun celebrity sightings and audit of the royalties to be paid to Ted Turner. So we found him a lot of money, so he liked us and he treated us well out in LA. After I left Price Waterhouse, I intentionally wanted to go to a more fun environment. I knew I wasn't going to stay to make partner. So I went to a startup company in Atlanta, and I also was interested in M&A. So at that time, IXL was formed here in Atlanta, and I was one of the early employees. Within a 2-year period, we did over 40 acquisitions of internet companies and an IPO. During that time, it was a lot of fun. It was a lot of hard work, but I had the opportunity in those 40 acquisitions to meet all of the entrepreneurs that had started their own businesses. Among those, Blake Patton. So Blake Patton is the general partner of Tech Square Ventures, and Tech Square Ventures manages both the Tech Square Fund and the Engage Venture Fund. One of the other founders was Neeraj Shah and Steve Conine. They now have the wildly popular and successful company Wayfair. So during that time, we had a great time with all the entrepreneurs and fast growth. After that, I took some time off with the family to have a family, did some consulting, and then started with a startup company that was based here in Atlanta, and it commercialized technology out of Emory University, a medical software company. So we started with ground floor there, and in this environment, of course, IXL, we did an IPO and raised funding. At Velocity, we grew through bootstrapping, and we worked with the ATDC, Georgia Research Alliance, and commercialized technology out of Emory University. Eventually, we did not raise venture funding there, and we sold the company to a strategic partner, Varian Medical, who bought the software, and they are a large vendor of cancer hardware and software. Stayed with Varian for about a little over a year doing the integration, and during those times, and that's kind of just to lay the groundwork, I've been in the startups, ground floor. I've also been in the corporates. So the skills that I want to really focus on today, and I'm so glad that you're interested in it this early, because you'll use this, whether you have a new idea or a new venture, or whether you decide to go with a corporate path. At some point in time, you're going to have an idea or a strategic initiative. Either way, whether you're in a large company or whether you have a new venture idea, you're going to need to build a plan, and you're going to need to convince someone else to invest in your plan. So one of the books that I like that is kind of very simple, and I don't know if you've seen this one or not, but it's an easy, it's nice to have on the Kindle, but it's also nice to have. It's called Get Backed, and it is about crafting your story. And so it goes through a very simple version of a pitch deck. And these are the slides that, kind of the areas of the story that the book covers. 3 of these slides are financial, or mostly financial related slides. And so, you could just do a deep dive on each of these elements. And the 3 financial elements are customer or market, business model, and use of funds. So just because of time, we are only going to focus on the business model today, but the other 2 financial slides are also extremely important. So the market tells you how large the potential is, and then use of funds will be a product of your business model. Here's an example, and the book has several examples of a business model for Airbnb. LinkedIn publishes, I believe they published one of their very early or their first pitch deck on their website. So you can go to that and you can see that the business model slide is just one slide and it has 3 numbers on it. So at the end of the day, you're going to have all these great models and details, but you're going to choose the most compelling metrics to tell your story. And that's what would end up on the business model slide. So throughout my journey and, with both being in the startup and in a corporation, people that are going to build a business model ask, what are the questions that investors ask? So, different investors obviously have different questions, and different funds have different strategies, but they all want to know, how attractive is the investment? And also, this is focused on that business model piece only. So I'm not going to cover how important is your team, how important is your, the customer and the product. So we're only covering topics related to the business model. So, if you are trying to pitch to a venture fund, some venture funds have different strategies. There's venture funds in Georgia that want to invest in Georgia companies. So they have a strategy to make returns, but to also invest in Georgia. The Engage Fund, which is one of the funds that TechSquare manages, it's a strategic corporate fund. So the 12 partners that are LPs in Engage want there to be a strategic fit for their investment. They want to follow the innovation. They want to invest in something that is technology that they know would be on their roadmap, or that they know will be a good partnership. So, and then a true venture fund that wants to invest in companies with just certain returns. They'll also have certain types of companies that they invest in. So they want to know, when will your company make money? how much will you burn per month? And a very important question is it capable of growing rapidly? You may have great numbers that are 20 years out in the future, but investment companies and venture capital firms have certain timelines that they need you to grow and to be successful within. And then they also want to know, what is the pricing of your product and how did you prove it? So these are some of the questions that investors ask. The question you're asking is, okay, how do I get started and how do I make it believable? So this is also from the Get Backed book, but I think it's really important. And there's 3 components of the business model, and the 3 components work together to tell your story. So we're going to go through and this is really what you really need to remember about building a model. So we're going to go through these today. First, you start with assumptions. The assumptions lead to projections, and the projections give you critical insights. And this is an iterative process. So the first area that we'll talk about is assumptions. And assumptions really are where you'll spend the most of your time. So these are just educated guesses. A great tool that you're probably familiar with, and if you're not, I highly recommend you go to this YouTube and watch the video of Alex Osterwalder. It's a funny, informative video, and he explains how to think about your business. So the business model canvas is a new way. You used to write a 40-page business plan to tell your story, and that was boring and difficult and not dynamic. You couldn't change it easily. You couldn't run various assumptions through. So this business model canvas helps you try and iterate, different assumptions. And it also is really just a starting point to say, here's the assumptions that you need. Here's the questions that you need to ask, in other words, to come up with your assumptions. So I recommend that you go and watch that video, and he'll tell you about really, okay, what are the assumptions? What are the questions that we need to ask? So when you do that, I would sit around with your team, sit around with your advisors, get the whiteboard out and walk through all of those assumptions and start making a list. So one of the most important areas of that is customers. So you want to figure out who is going to buy, and you need to be, and these are the things that you need to be able to explain to potential investors. Once you finish this process and you get around the room and the investors start asking you questions about your model, they're going to ask you who are your customers, who is going to buy it, and how will you get them. So you really, and this is, if you're starting to think about this, how will you get your customers? Do you need to hire salespeople? Do you need to create content on your website to drive traffic? So start listing all of those elements, because you're going to need to gather the cost of doing that. And when will you get them? So you'll see later that the business model is broken down by month. It's very granular, and then it summarizes by quarter and by year. So you need to determine, based on what you do up front, your web traffic, your salespeople, how long will it take for you to get those customers, and when will they start coming in? So how many new customers per month? What will you charge them? Pricing is very difficult to determine, and there are a lot of experts that you can meet with, or that you can read from and attend classes on. But how will you determine how much you charge your customers? And the number one, the best way is delighting the customer and creating something that is so compelling that they're willing to pay for it. So really, what is the value that they're getting from your product? And then it's very important to know, how long will you keep those customers, because you're going to be forecasting the revenue over a period of time. So how long will you keep them, and how much will you pay? How much will they pay you over their lifetime as a customer? And then how many of those customers will leave? One example is LinkedIn. I love LinkedIn, but I don't love the monthly fees. I think it's $39 a month. And I just, if you're not in the market, I don't know a true value for me of paying $40 a month to be on LinkedIn. So I've gone on and I've paid the $40 a month and then I've gone off. So churn is who leaves and how many. So some of the cost of a technology company, what do you think are the most significant costs for tech companies? Team. So headcount is the number one driver of cost. So when we worked at Velocity, one of our really rules was we're not going to hire anyone unless they can develop or in order of priority of hiring, we need to develop the product. So who's going to develop the product, sell the product, or train on the product? So we kind of prioritized around product development and engineering. Then, of course, you do layer in. So when you're thinking about a model, when you're thinking about your cost, you need to prioritize which ones are first. Then second would be, and it really also always depends. There's not a one size fits all, but it always depends. Then once you have a product, you obviously need someone to sell it, and then someone that's going to guarantee the customer success. And then you have your general administrative expenses. The highest general administrative expenses, which I'll call G&A, is usually rent, and that's a tough one to see. If you can find a good place that is not so expensive when you're just starting, depending on how fast you're growing, how many people you have, and whether you have funding or not, it's key to think about how much you're spending on rent. So I am going to pause here just to kind of get a level set of where we are and see if there's any questions in the chat, because I cannot see the chat. So I don't know if we have any questions yet, Nami, but I do want to make it conversational. If you have any thoughts yet, if you have any questions.
I have a question.
Sure, great. And also, would you please state your name?
Yeah, of course. I'm Leander Howard II. I have a business right now. It's a resume writing business and career advancement services company I just started about 6 months ago. But most definitely want to be a serial entrepreneur. So I know one thing I've struggled with my business over the past 6 months is finding those good people, right? To maybe build the product, like you mentioned, software developers. So I mean, it most definitely is important. So do you have any advice on finding those people to come into the business, and then how would you allocate or budget that spending towards their skill sets when it comes to salary?
Mm-hmm. Well, that's a tough one because you either need some money to hire them.
Right.
So
Right.
I think what the question is, and that's kind of where bootstrapping comes in. So some founders are fortunate enough to also be developers, and that was the case with when I mentioned Wayfair. The two founders were engineers, and one of them was extremely strong in also operations and scaling business. So they did most everything themselves up front. If you don't have revenue yet, you're going to have to find either some funding or find other friends. I mean, this is at Velocity. We used a lot of friends and family to help fill in the gaps. So if you know someone that is either a friend or a family that's willing to, hey, I'll give you some ownership. So stock options is a currency when you don't yet have cash. So if you can get someone to believe enough in your vision and your product to say, hey, I don't have the cash to pay you right now, but if you believe in this with me, or if you will help me develop this product, either I'll pay you once we get to milestones, like once we get to 25,000 in revenue, 50,000 in revenue, I'll give you X. Are you willing to take that trade? Are you willing to put in sweat equity and then I'll pay you after we get to this point? And I would be careful with giving away too many stock options. There's a strategy of that. But if it's a co-founder or if it's a significant person, the CTO that's going to be with you for the long term, then you can consider, giving away some of your some of your business? And I love that question. That's a great question, and I'm glad that you've gotten started already. It's exciting.
Thank
Does anyone else?
You
Yep.
have, I don't know, Michael Allen Fisher. Do you want to unmute yourself and ask your question? The mute button is at the top in the middle if you're on a laptop, if you're on a desktop or a laptop. I don't know if you see that at the top. I can also unmute you as well.
Okay, actually, I can see the chat since I'm not sharing my screen. Let's see, unless Michael, unless you're getting prioritize the
Okay, I can
story.
unmute myself.
Oh,
Yeah,
okay.
so I was wondering what's more important, the financial model or the story? Or is the reality they're both equally important because you're not getting investment unless you have both?
Great question, Michael. Um, you can't get one without the other. If you have a great story, but not a model that supports it, that validates it, then it's gonna be very hard to convince someone, especially a VC, to invest in your company. If you have a great model that tells you all the numbers they want to know and meets all of the requirements, but your product or your story there's something not compelling about it, then you also won't get the funding. So you need all the elements, and you need to be able to convince with the model. The model helps you convince others that you have a compelling story, and so that's why the model is so important. And you can even have a great story and a great model, but some VCs just have certain criteria that the results of that model may not fit as well. So there's a lot of different types of funding, and you go back and with the model, it'll help you figure out exactly what you need.
Okay.
Thank you for that question.
We have another question from Womack Mac. If you want to unmute yourself.
Okay, I guess I'm unmuted. Can you hear me?
Yes.
Yeah, we can hear you.
Hello. Okay. How do we get access to the information to support our assumptions and projections? So it's the information to make it right.
Okay, so that is really, you're going to have to be the expert, and that's why I think I'm so happy that all of you guys are here and care about this topic, because I think a lot of misconceptions are, I've got the idea, I'm going to own the product, okay, but I'm not going to own the business model. I'm going to go over here and develop, and I'm going to go hire a finance person or a consultant to own the model. Those people can absolutely help you in asking you the right questions. And that's really what that business model canvas will also help you as to, where do you get the answers. But, you are the expert, and we can ask you and try to drive the answers out of you. And the business model canvas can try to drive the answers out of you and ask you the right questions. But you're going to know. And so if you don't yet know, there's some, one of the best ways is to look at other comparable companies. So, go to another company that's already public. So if you have a business model that's similar to, LinkedIn, Airbnb, look up their financial statements and their SEC filings, and they tell you the complete story of all of their risk factors, pretty much all of their assumptions. You can compare your metrics to their metrics. So using comparables is a great way to get started on some of these things, on pricing. And then eventually you'll need to say, here's how I'm different. But if you can find those companies or products that are similar to yours, and if they're not public, then there might be analyst research or other information that is out there. So just do as much research as you can about what is a similar product or service or business model that's similar to your idea and your product. Thank you. Great
Joelle,
question.
do you have time for another question before, or do you want to move on?
I can take
Okay.
another question. I
Okay.
want to
So you
make
have,
sure we're answering the right things.
okay, so for this section, Leander has another question. And then if we jump back into the presentation, Leander, do you want to ask your question?
Please. Can you hear me?
Yes, I can hear you.
Okay, cool. I guess I'll skip the one I put. I want to ask, what are investors, what percentage are they expecting back from the investment? Like, do you have like a range of like what type of return they're looking for
Great
when
question.
they are investing?
I knew that was coming. Um, it depends. It depends on the strategy of the investment firm, of the venture capital firm. But a lot of VCs, it's safe to say that they're looking for a 10x return, that you need to prove to them that you could have a 10x return for them. So 10 times what they put into it, because venture investments are highly risky, and there's a better chance that only one or two will succeed and most of their investments will fail. So each investment they make needs to have a very high potential for success, so that the ones that fail, they're expecting some to fail, but the ones that succeed kind of, carry the portfolio. A great
Cool.
question.
Thank
Okay. All right, I'm going to start sharing again. Um, okay, so we covered assumptions, and one thing I briefly touched on is that they're educated guesses. So don't be afraid to start. Don't be afraid to start somewhere with the comparables, and don't just pass this off to someone on your finance team. It's kind of like if you need to build a website and you tell somebody just to go build your website, but you don't give them any direction or tell them how you want it to look or what you want it to be, or the same with your product. So you really need to own the process so that you feel confident about giving the answers to the investors. So the second component of the business model are the projections. So all of the assumptions that you came up with in the first exercise and with the business model canvas, you're going to use those to create financials. And I'm going to walk you through the details. So some of this might be too obvious, too basic, but I want to also just make sure that everybody understands some of the terms. Because you want to speak the language, and you can remove the intimidation factor. I look at this slide, and I don't know if you guys are developers or what, but we have kind of a funny joke at Engage and Tech Square is like Kubernetes. Like when you say Kubernetes, like who knows what that is? Most of you probably do. I've recently learned about it, but it's kind of like it's like a different language to me in a sense. So this is just like Kubernetes is to you. Burn. When someone says, what is your burn? That's your net cash out in the period. So it's whatever, if you're bringing in cash and spending cash, it's the net number. A lot of early stage startups are only spending money. So like your scenario where, I'm not sure if you have revenue yet, but you need to hire some people. So when you hire those developers, you're going to have costs, but you may not have revenue yet. So your burn would be all of the cash out, either, usually it's on a monthly basis. Break even is just the point of how many months until you start producing enough revenue to cover all of your expenses. Churn is the number of customers lost during the period divided by the total number of customers at the beginning of the period. This is important because this drives a lot of the questions that investors are going to ask. So you need to track all of your customers and the number of customers and understand your churn. This is another area where you can go out and look at comparable companies and see what their churn rates are to compare to your company to see if your churn is higher or lower than theirs. LTV is lifetime value of a customer. And some of these are also SaaS company specific terms, and they may not all relate to your type of business. But if you're interested in creating or have a SaaS company, these absolutely are metrics you need to know. And lifetime value is one that everyone should know regardless. So it's all of the revenue expected from your customers multiplied by your gross margin, which we're going to go into what gross margin is later, divided by your churn. So all of these elements start to layer onto each other. Bootstrapping is just building your business organically with customers or partnerships or personal funding, and it's what a lot of companies have to do to get the product off the ground. Not everyone gets venture funding right away. In fact, Velocity, we never received venture funding, and so we had to develop a model where we knew the revenue would cover our expenses. And dilution is every time a company issues new stock or options. So this is where you need to be careful with your options and when you ask, how much does a venture capitalist need to make? A venture capitalist is going to look at all of your expected issues of new stock in the future. How much funding will you need in the future? Because every time you raise funding, you're going to dilute yourself and the other investors. So all the existing stockholders' ownership decreases every time you allow new shareholders in. Bottoms up and top down. So these are really just two methodologies in building a forecast. And bottoms up is where you have to start when you have a startup. When you have a pre-revenue company or an early stage startup, you have to go bottoms up. And that just means that you're looking at your assumptions, you're determining how many customers will I get, at what price, and you're extrapolating that, and you're determining, when they come in over time. The top-down approach was that other slide that I said we're not really going to talk about, which is market. You really need to compare what you come up with in your model to a top-down approach. And a top-down approach is, what is the total potential market size? What is the total revenue? If I got every customer that was interested in buying this, what is the potential? And compare that to what your model says as a percentage. So you might say, based on our bottoms-up approach, it's about 1% of the market, or X% of the total market, just because it's a good yardstick so that you can measure kind of where you are. If you're at 20, 30, 40, 50% of the market, that's going to be less believable, if believable at all. Sensitivity analysis is just building financials with assumptions that are dynamic. So you want to, in all of your models, and when we go into the detail, I'll show you, but you're going to want to show best case, worst case, and likely. So assumptions played out over time determine your financial health. So we're going to kind of walk through these and see how I'm doing on time. We've got 20 minutes. So a P&L is the profit and loss statement, and it shows all of your revenues and costs. The balance sheet shows your assets, liabilities, and equity. Your cash flow statement, that's where it shows your burn and when cash is needed and how much. And then your cap table shows the dilution. So these are the four elements. The way that I'm going to show you the step-by-step approach is into these 5 pieces. So the model I'm going to show you is going to show the summary statements, financial statements up front in a summary form. It's going to be driven by your assumptions that you came up with earlier around customers and sales. Then it's going to be, the costs are going to be driven by headcount, which we said are usually the highest cost. And then your G&A expenses and your financing expectations. So this is just a snapshot of one way of doing this. There are templates out there. They usually try to sell them to you, and I don't know that they're that useful. There is the Atlanta Tech Village has a template that's great and it's free. It's on atlantaventures.com. That may be in my resource slide, but it's a good starting point just so that you can visualize it and you can see another way of doing it. But this template is just one way of doing your model. So you can see the 5 steps, the 5 pieces. The very first tab that we built in this simple model is the summary statements, and then the sales assumptions, hiring plan expenses, and financing. So the income statement just shows, are you profitable over time? So it's for a period of time. It brings in like, revenue and cost between January 1st and December 31st, or January 1st and March 31st for the quarter. This is a sample income statement. This is this tab here, the first piece, the statements. This is just the income statement. It's all, we put all of the summaries in that first tab. So this is a roll up of all of the detail behind, and this is just the income statement piece. As you can see, it shows just the summary. This is the total revenue, the gross profit. So when we talked about gross profit is a very important metric, investors are going to want to see a high gross profit margin, and that is your revenue less the cost to produce that revenue. It gives you your gross profit and then your margin. You have sales and marketing expenses, R&D expenses, and then general administrative expenses. These are the main chunks that are always shown in a income statement. And then down here you have your net income and your net operating margin. So operating margin is the bottom line number divided by revenue, and the gross margin is the gross profit divided by revenue. I'm sorry if that is like obvious to you guys. Then we have the balance sheet. The balance sheet is really just a snapshot like your checkbook. It's at a point in time. Today, we have cash and assets of this, less liabilities, which would be payments due to vendors for cloud services, hosting, payroll. So your balance sheet is a snapshot in time. This is an example on that summary tab of the balance sheet. This is all driven, by the way, these are not hard-coded numbers. These are all driven from the detail. So you can see down here in equity, we're going to make some assumptions later about financing. This shows that we started out with $200,000 of the owner's equity. So, whatever you have to put into the company, it's great to show that you are willing to make a sacrifice. So not everybody, most people don't have 200,000 that they're willing to put in. Some people do, but if you can gather some friends and family, gather whatever you have to put into equity, that shows a sign that you're willing to make an investment in the product of the company. The statement of cash flows, this is where it shows your burn. This is critical to determine your financing needs. So I just want to point out down here that it's going to take your net income, which is a loss. This is a loss. It's going to add in what the founders put in, and it shows you your cash at the end of the period. So cash flow, net cash flow, this line here, can be negative, but your cash balance can't. So cash flow can be negative if you don't have revenue yet, but you have expenses. So that's where you need to figure out, how am I going to fund these expenses? Okay, so this is that second piece of the assumptions and in building out your model. Really, all I want to show here is that these are the customer assumptions. So the assumptions that that you came up with in the beginning. All of the numbers in blue are you hard code these in. So these are assumptions that you're making. This is what we think our growth will be. This is how much we're going to have to pay to get someone to click on our website. This is what this is where you would put in pricing. This drives the actual revenue number. So it's just, it's customers times number of customers times the revenue pricing. And then the third piece on headcount. So, this is where it's detail. You're laying it out. So when we say, let us see your detail, how much you're going to spend in order to develop your product. If your business model says you're going to develop a great product, then we're going to need to see that you've thought about the costs that go into that. So this is showing mostly sales, but of course it goes down into development, R&D, and like I said, you prioritize your salaries, but you can also see that you make all these assumptions about the salary and when they starting month. So some of these people aren't starting out until 2021, but you're doing, usually investors want to see a 3-year model, or at least until you're going to be profitable. And then this is the fourth tab. The fourth step is just your G&A. This is probably going to be your easiest one because and this is where you can just use other assumptions, or like I said, the highest number here is usually rent. So this is where you say annually I've got to pay insurance. It's going to be $8,000. You just extrapolate that over the year in the financial statement for each month. You say I'm going to spend probably $15,000 the first year on legal, $30,000 the second year. So you have all these costs. These are just your general and administrative costs. And the fifth tab was the financing assumptions. So this is where you had 2 founders. And one founder was able to put in $100,000, the other put in another $100,000, and that was where the $200,000 showed up on the balance sheet earlier. And then it shows, it's really important to say how much money are we going to need later, which is pretty much determined from that cash flow statement. So when I said your cash flow can be negative, but your cash balance can't, you continually look at your cash flow statement to see, wow, in month 7, we're going to have negative cash. So we need to raise money before, or during month 7 so that we can continue to fund operations. And that's where these assumptions came from. Okay. I'm going to pause again for questions. So I know we moved through that pretty quickly and we're running a little bit low on time. If we don't have any questions in the chat, should I keep going, Risha and Nami?
Yes, except we do have a couple of questions.
Okay.
Do you want to go through the next set, or do you want to work on answering those questions?
Let's go through the next set, and then we'll go to the questions.
Awesome.
Okay, because I want to get through the third element, and that's the critical insights. So these are the critical insights that some of the types of critical insights that the model will give you. So one is customer acquisition cost, which is extremely important. So we're going to walk through an example of that one. So I'm going to move quickly. Lifetime value is what we talked about. We're going to walk through an example of that one. Payback period of customer acquisition costs. So these are the types of metrics that when you look at them and you compare them to other companies in your industry, if they are extremely high or low, you're going to have to explain that. And it could mean that your assumptions need to change. It could mean that the cost to acquire customer is either understated or overstated. So when you go back to how are we going to acquire these customers and how are we going to bring them in, you may need to adjust your assumptions if these metrics, these are the unit economics. If they don't make sense, you'll need to go back and either adjust your assumptions or make sure that, your model is working. Break even is just the payback period that we talked about before. So customer acquisition costs are all the costs spent on acquiring customers over the number of customers acquired. So this example just shows, and this is to show you that your costs aren't $2, they're $250 because you paid $2,000 total cost and you had 1,000 visitors. So it was $2 to get a visitor to come to your site. And this is for web traffic, this example. You paid $2 to get a visitor to come to your site, but you only got 20 leads out of the visitors and 8 customers. So the 2,000 divided by 8 is $250. So your cost per customer is $250. So just make sure that you're measuring the right metrics. Another way to look at customer acquisition costs, or another way you look at it, is to total all of your costs So all of your costs that you spend on visitors, all of your paid marketing spend, the total of your organic and paid acquisition cost is 28. Your total customers at the end were 23. So your total cost to acquire one customer is is about $1,200. So lifetime value, this is a calculation. I'm going to come back to this if you guys are interested, because I don't want to go into the details since we don't have much time, so we can get to any questions. And also, if you do have additional questions, you can follow up with an email. This is an important metric that VCs look at. Customer acquisition cost need to be, or the lifetime value of the customer needs to be a 3x multiple of the cost to acquire them. So you want to make sure, like, out of all these costs I'm spending to get a customer, I need to make sure that I'm going to get repaid in the value over the time period of having that customer, that I'm going to be repaid for all these costs, that it's worth, that the model is worth it. So this is where you show whether or not you have a compelling product and whether or not you're delivering value. So in this case, it's taking 5 months to recover your cost of keeping that customer for a lifetime. So that's very good. And as a benchmark, VCs want to see that you can recover your cost to acquire a customer in 12 months or less. So the 3 elements again, your assumptions were the most important. That's where we started. They help you create your projections and you gain critical insights. This is where you need to sit around with your team of advisors, your team of founders and leaders, and the business development teams, and look at the critical insights. Look at your lifetime value. Look at your customer acquisition costs. Look at your payback period. Look at all of those metrics that came out on the back end. Do your comparisons and say, does this business model even make sense? So if it doesn't make sense, and even if it does, you're going to iterate the model. You're going to iterate the feedback loop. So you go back and you look at your assumptions again. We're not charging enough. We're not making enough money per customer. So is this truly the most we can charge? Or are we spending too much to get the customers? Do we have the right customers? So it raises questions. The critical insights and the metrics that we just talked about raises questions so that you can go back to your assumptions. Here's some additional resources, and I'm going to leave it on this page. This is, some of the places that can help you are ATDC, the Atlanta Technology and Development Center. Obviously, CreateX at Georgia Tech and Student Innovation. Blake Patton, the general partner, teaches a great entrepreneurial finance class where he talks about all of these elements in much more detail. And then you have Atlanta wants you to succeed. We want to produce good entrepreneurs here. So there's a lot of good mentorship opportunities. All right. Sorry about that last section. I think I flew through that. But if you have a specific question, you can email me and I'll try to get to it. Or I'll pass it along to another team member.
Hey, Joel. So we have all of 5 minutes, but we'll see what the questions are, how we can get to the questions. Walmart had asked, what percentage should the salaries be of revenue?
I think that really depends because are you talking about at what stage in the business? There's I probably, and also what is your product and what is your revenue? So some companies, if they're in the early stage and don't have that much revenue, then obviously it's going to be a much higher percentage. So I don't know if and they're probably. There's metrics by industry. So certain industries will have different numbers that have higher, that have higher needs for people, more expensive needs for, higher paid engineers.
Thank you. The next question from Revant.
And I'll follow
Public
up with,
companies. Oh,
sorry, Risha. I'll follow up with your G&A should not be your largest expenses, or your CEO salary and your CTO, those should not be your largest headcount expenses. Your salary needs to be, how am I going to build the product and get the product to market? That's just a side suggestion. Go ahead.
fantastic. Public companies have public resources for all to learn about the company's financial and operations, churn, cost, burn, everything. Are there any resources available to learn about competitors and their market outlook for private or startup companies?
That one's really hard, and that's one of the reasons that a lot of companies don't want to go public, because they don't want to publish their information too early. So I would say that there are research analysts and research opportunities, and I don't know if any of you that are participating know of any, but there's PitchBook is a resource that tries to accumulate VC. They try to get information from VCs that they anonymize. So there are researchers just, searching the web. Like I said, a lot of companies, well, those are mostly public, but it's difficult. But there are some research analysts that have it. Sometimes you have to pay for it. So hard to find.
Thank you. Walmart Mac had another question. I want to make sure that we cover that if possible. What are some good sources of information to get the conversion rates? Will this be in the compare? Don't know if you, he says, will this be in the comparables as well? Or Mac, I don't know if you want to.
Well, basically,
I may not have.
everyone's trying to get at the same thing, like what is the source of information. So, like I guess PitchBook would be one that you just mentioned. The comparables will give us some idea, but particularly, I'm looking at the conversion rate because although I'm early stage revenue, I'm trying to make sure as I get these projections, like what will be the conversion rate for, let's say, a Google ad, and how much that will cost, so I could tell that story and with a great degree of confidence.
Mm-hmm. I'm sure that, so all of these things are kind of, I mentioned PitchBook. That is extremely expensive to try to get data from them. Other than a Google search of what's in your industry, I mean, you can email me that, and I can ask some of the guys. Like I know that we have internal metrics, so ask around, ask other entrepreneurs, but also VCs will have some idea. I can tell you what we're looking for, what we see a lot of. So if you want to email me that separate specific question, I can try to get that for you.
We have one question from Juan Carlos Sanchez. The question is, when is the right time to get involved in VC conversion, or should one start with angel investors instead?
It really depends on where you are in your stage and how much money you need. So angels are they have a certain amount that they would fund, and you really usually do start with angels, or you if you can't self-fund. But if you are at a stage of where you already have your product, you definitely need to have what they call product market fit. And I should also say it depends, because Engage Fund, like I said, has a different strategy for investment than like
It's $12.
So some of the funds will have strategies around earlier investments, and if you have a good corporate fit with your product, you might be able to get funding from a VC. So it really depends. I'm sorry for that answer.
Thank you, and I apologize for my computer. So these are fantastic. Thank you so much. Want to recognize the fact that we are at time in terms of 12. And so I don't know if Joelle has the ability to stay on for about the next 2 to 3 minutes. But I want to thank everyone for being on the call today. Just to honor that time, that if you want to jump off the call, you can do that. But we're going to probably stay on for about 5 more minutes to make sure that we answer any outstanding questions if possible. But again, Joelle, it was fantastic as usual. Your brilliant insight is always great to hear. And Engages, there's a resource as well. Any final words before we ask again if there's any questions, Joel?
I just thank you all for being here. You have a head start on so many things here by just being interested in this and showing a desire to own it this early, because it does come down to, you are the expert and you are the one that can figure out these the answers to these questions and then be able to confidently defend it. So thank you all, and I really hope that we create an engine of companies, and that we see you one day in our offices giving your pitch. Good luck.